Today is January 21st, 2026, and I need you to stop what you're doing for a second. While the financial media was talking about gold fatigue and high interest rates, while analysts were telling you the metal's bull run was over, something historic just happened this afternoon. Platinum, the metal that everyone called dead for a decade, just vaporized its previous all-time high. I'm talking about a vertical move past $2,500 per ounce that caught the mainstream completely off guard. I was looking at the charts a few hours ago at around 1:50 p.m. Eastern, and the price action was unlike anything I've seen in 12 years of analyzing commodities markets and stacking physical metal. This isn't retail FOMO. This is industrial panic, and the data coming out of the LMBA suggests this isn't a spike. This is a total failure of the supply chain. The talking heads want you focused on gold's consolidation at 4,800. They want you to believe the story is over. But the real story isn't about gold's exhaustion. It's about the great rotation. Smart money is exiting the gold trade and flooding into the most undervalued asset on the planet. And if you think 2,500 is high, you haven't seen what happens when the baker runs out of bread. Here's what I'm going to walk you through. First, I'm going to show you the mechanism of backwardation that is currently trapping short sellers in a position they cannot escape. Second, I'm going to run the mean reversion math that points to a $5,700 price target and explain why even that might be conservative. Third, I'm going to share my personal battle plan for the next 48 hours, including the exact triggers I'm watching before I make my next move. Because here's the primary claim I'm making. We are witnessing a structural breakout driven by a 3-year supply deficit and platinum's new status as the gold of the hydrogen economy. The underpricing is absurd. Platinum is 20 times rarer than gold, yet it's trading at nearly half the price. That math is mathematically unsustainable, and the physical vaults are telling a story that the paper markets are desperately trying to ignore. So let's get into it. Let me give you the snapshot from this afternoon. Platinum was trading at 25.10, up 1.65%. That's a confirmed breakout above the 2200 resistance level that held for months. Gold was sitting at 48.40. Silver was showing weakness at 93.37, down about 1.6%. The gold to platinum ratio hit 1.93. I'll come back to why that number matters in a minute. Now here's the contrast that should make you uncomfortable. In the paper markets, COMEX, LBMA, analysts are forecasting an average price of $22.22 for the year. The market is already trading 13% above the expert consensus for 2026, and we're not even a month into the year. But the real story isn't on the screen. While the spot price shows 25.10, above-ground platinum stocks have been depleted by 42%. We are down to less than 5 months of global demand cover. Stop and look at that vertical line on the chart. That isn't speculation. That is industrial buyers realizing they are fighting over a vanishingly small pool of metal. Which brings us to the most dangerous word in commodities, backwardation. Let me explain backwardation in the simplest terms possible, because this is the key to understanding why this move is different. Backwardation is a market condition where the price for immediate delivery, the spot price, is higher than the price for delivery in the future. That sounds technical, but the mechanism is simple, and it's terrifying. It means the market is so broken that people are paying a premium to have the metal now because they don't believe it will be available later. Think of it like this. Imagine a bakery. Normally you can pre-order a loaf of bread for next month for $7, or buy one today for $7. But today, the bakery is charging $10 for a loaf right now, and still only $7 if you want to pick it up next month. Why would anyone pay that $3 starvation premium? Because the shelves are nearly empty, and they don't trust that the baker will have flour next week. That's backwardation. It's the ultimate red alert. It signals physical desperation, not speculative bubbles. And platinum is in steep backwardation right now. Industrial users, hydrogen fuel cell manufacturers, automotive catalytic converter producers are paying premiums for immediate delivery. This is a physical squeeze, and it's accelerating. But here's what makes this even more dangerous. The real starvation isn't coming from the buyers. It's coming from the mines themselves. Let's talk about scarcity, because the numbers are staggering. For every 1 ounce of platinum that gets pulled out of the ground, miners extract 15 to 20 ounces of gold. Platinum is 20 times rarer than gold. Yet right now, platinum is trading at roughly half the price of gold. That ratio is historically insane. Let me run the conservative scenario for you, what I call the mean reversion trade. Historically, platinum trades at about 1.2 times the price of gold. That's the long-term average when both metals are fairly valued relative to their scarcity. Gold is currently at 48.40. If platinum simply returns to that historical average relationship, we're looking at 5,800 per ounce. That's not a moonshot prediction. That's a return to normal. Now let's stress test that with a supply deficit. The World Platinum Investment Council confirmed a shortage of 692,000 ounces in 2025. South African production, which accounts for 70% of global supply, is down 5% year over year. The LBMA analyst range for 2026 is 1,300 on the low end to 3,600 on the high end. Even the most bullish analyst in that range, Bruce Ikemizu at 3,600, is arguably being conservative if the supply concentration in South Africa continues to crumble, and it is crumbling. The South African power grid is unstable. Rolling blackouts are disrupting mining operations on a near constant basis. You can't mine more metal if the electricity isn't running, no matter how high the price goes. So here's what we know so far. The gold to platinum ratio is at a historic extreme. The physical vaults are 42% empty. The market is in a starvation pricing model, and the primary source of supply is geographically concentrated in a region with failing infrastructure. This is the setup for structural repricing, not a speculative blip. So why isn't everyone buying? Because the skeptics have one final card to play, and we need to address it head on. The argument goes like this. This is a blow-off top. High prices will fix high prices. At $2,500 per ounce, recycling will surge by 10%, and manufacturers will substitute back to palladium, which is currently trading at a bargain price of $18.64. It sounds logical, and if this were a normal commodity cycle, I'd probably agree. But here's why that argument falls apart. First, substitution takes years of retooling. You can't just flip a switch in a hydrogen fuel cell plant and swap platinum for palladium. The infrastructure investments are massive, and the technical specifications are different. The hydrogen economy demand is structural and critical. It's not price elastic in the short term. Second, the idea that high prices solve scarcity ignores the South African grid collapse. You can't incentivize more mining if the mines physically cannot operate. Third, and this is the part that should make skeptics uncomfortable, look at what's happening to palladium right now. Palladium is dropping while platinum rises. The substitution narrative is working in reverse. Manufacturers aren't switching from platinum to palladium. They're doing the opposite because they're betting on hydrogen infrastructure, not internal combustion engines. The market is pricing in a paradigm shift, and the bears are still fighting the last war. While the skeptics wait for a crash that isn't coming, institutions are already changing the rules behind the scenes. Let me walk you through what I'm watching over the next few days and weeks. First, institutional reaction. The LBMA could potentially raise margin requirements to force speculators out and cool the market. That's the traditional playbook when a commodity goes parabolic. But here's the problem. This isn't a speculative bubble. It's a physical shortage. Raising margins might shake out leveraged traders, but it won't create more metal. Second, the rumor mill. And I want to be clear, this is unverified speculation, but it's circulating among people I trust. There are whispers that private family offices in Singapore are draining the last physical bars from LBMA vaults, leaving unallocated paper holders with nothing but digital receipts. If that's true, and if there's a mismatch between allocated and unallocated positions, we could see a run on physical that makes the current backwardation look tame. Third, the indicators I'm tracking in real time. Indicator 1, South African Mining Union reports. If the Bushveld Complex mines face permanent closures due to power grid failure, the $3,600 target becomes the floor, not the ceiling. Indicator 2, lease rates. If the cost to borrow platinum stays elevated or climbs higher, the squeeze is intensifying. Lease rates are the canary in the coal mine for physical tightness. When institutions are desperate to borrow metal to cover short positions, lease rates spike. Right now, they're elevated. If they normalize or drop suddenly, that suggests the immediate physical desperation is easing, and I would interpret that as a signal to sit on my hands. But if lease rates keep climbing, that tells me the short sellers are trapped and the squeeze is accelerating. This brings me to how I'm navigating this minefield personally. Let me be direct about where I stand right now. I'm not chasing the vertical line. I've been in this game long enough to know that when something goes parabolic, your risk reward on new entries gets brutal. But I am also not selling a single ounce of my physical platinum. Here's why. I'm playing the mean reversion trade, not the squeeze trade. If this breakout holds through the weekly close, I consider the 2,500 resistance level dead. That level becomes the new floor. And if that's the case, the structural repricing is just getting started. Now, here are my 3 triggers for action. Trigger 1, the 2,200 retest. If platinum pulls back to the 2,200 level, the breakout point, and holds it as support, I would personally look to add to my physical allocation. That would confirm the breakout is legitimate and not just a short-term spike. Trigger 2, lease rates. If I see lease rates normalize or drop suddenly, I'm sitting on my hands. That would suggest the immediate physical desperation is easing and the parabolic move might be losing steam. But if lease rates stay elevated or climb, that's my signal that the squeeze is real and ongoing. Trigger 3, the gold to platinum ratio. If the ratio hits 1.2, meaning platinum reaches roughly 5,700 based on gold's current price, I would personally evaluate rotating some of my platinum gains back into silver. Why silver? Because at that point, platinum would be fairly valued relative to gold, and silver would likely still be undervalued relative to both. That's the mean reversion playbook. You don't chase the metal that's already run. You rotate into the metal that hasn't moved yet. My logic is simple. I'm not trying to call the top. I'm trying to position for the structural repricing that the data says is inevitable. If the 5,700 mean reversion target gets hit, I'll reassess. If it blows past that level and keeps running, I'll hold and watch the lease rates. But I'm not going to panic, sell into strength, and I'm not going to FOMO, buy into a vertical move. This is about conviction based on supply and demand fundamentals, not emotion. Let me pull this all together. Platinum is the rarest major precious metal. It's in a massive multi-year supply deficit. The market is in a state of physical panic, evidenced by backwardation, a pricing structure that only emerges when people don't trust future supply. The gold to platinum ratio is at a historic extreme that defies the scarcity math, and the primary source of supply is concentrated in a geopolitically unstable region with a failing power grid. This is not a speculative bubble. This is a structural repricing. We are watching the end of what I call the laggard stigma, the decade-long narrative that platinum was dead, that it had no future, that it was a relic of the internal combustion engine era. That narrative is dying in real time. The most undervalued asset in the world is finally demanding its throne. And here's what makes this moment so critical. The mainstream doesn't get it yet. The financial media is still talking about gold fatigue. The analysts are still publishing forecasts that the market has already blown past. But the insiders, the industrial buyers, the family offices, the people who understand supply chains, they're acting. And they're acting with urgency. Now, I want to address something that might be on your mind. Why did this move happen now? Why did platinum break out this week, while gold is consolidating at 4840? The answer is gold itself. Gold hitting 4800 was the catalyst. When gold reached that level, it sent a signal to the broader metals market. Real assets are repricing. Inflation expectations are shifting, currency debasement concerns are accelerating, and investors are looking for the next asymmetric bet. Platinum, trading at half the price of gold despite being 20 times rarer, became the obvious candidate. The rotation from gold into platinum isn't about gold weakness. It's about capital seeking the next undervalued opportunity in the precious metals complex. If you want to understand why gold at 4840 triggered this move, I covered the LBMA's initial 2026 gold warnings in a previous deep dive. That video explains the macro setup that made this platinum breakout inevitable. History is moving fast right now, and the window to position intelligently is narrowing. I want to come back to something I mentioned earlier because it's easy to gloss over, but it's the most important part of this entire thesis. Industrial buyers are the ones driving this move, not speculators, not retail investors, not even institutional long-only funds. Industrial users of platinum, the companies that need this metal to build hydrogen fuel cells, catalytic converters, chemical refining equipment, are the ones paying premiums for immediate delivery. That tells you everything you need to know about the desperation in this market. When an industrial buyer pays a backwardation premium, they're essentially saying, I need this metal more than I need the cash, and I don't trust that I'll be able to get it later at any price. That's not speculative behavior. That's survival behavior. And it's accelerating. The hydrogen economy is not maybe anymore, it's happening. Governments are subsidizing infrastructure. Automakers are building fuel cell vehicles. Energy companies are investing in green hydrogen production. And all of it requires platinum. There is no substitute for platinum in proton exchange membrane fuel cells. The chemistry doesn't work with anything else. So when you see platinum in backwardation, what you're really seeing is the leading edge of a demand wave that is structural, not cyclical. This isn't a temporary spike that will reverse when the economy slows down. This is a multi-decade infrastructure build-out, and the primary input is in a supply deficit. That's the setup for a sustained bull market, not a short-term trade. Let me give you one more data point that should make you uncomfortable. Above-ground platinum stocks, the physical inventory sitting in vaults ready to be sold, are down 42%. That's not a normal drawdown. That's a crisis-level depletion. We are sitting on less than 5 months of global demand cover. To put that in perspective, the gold market typically holds 18 to 24 months of demand in above-ground stocks. Platinum is at a fraction of that buffer. What happens when those vaults run dry? You get what we're seeing right now: backwardation, vertical price moves, and industrial panic. But here's the kicker. Even if prices double from here, it takes years to bring new mine supply online. Platinum mining is capital intensive, geographically concentrated, and dependent on infrastructure that is currently failing. You can't just drill a new well and start pumping platinum out of the ground. The permitting process alone takes years. The capital investment runs into the billions. And you need political stability and reliable electricity. Two things that are in short supply in South Africa right now. So when people say high prices will solve the shortage, they're ignoring the time lag. Even if every mine in South Africa ramped up production tomorrow, which they can't, it would take years for that new supply to hit the market. In the meantime, demand is growing and inventories are shrinking. That's the definition of a structural squeeze. I keep coming back to the gold to platinum ratio because it's the single most important number in this entire analysis. Right now, that ratio is sitting at 1.93. That means you can buy 1 ounce of platinum for roughly half the price of 1 ounce of gold. But platinum is 20 times rarer. Let that sink in. The rarer metal is trading at half the price. Historically, platinum trades at a premium to gold. The long-term average is about 1.2 times the price of gold. There have been periods where platinum traded as high as 2.5 times the price of gold, because that's what the scarcity math justified. So why is platinum so cheap right now? Because for the last decade, the market narrative was that platinum was dying. Electric vehicles were going to kill catalytic converter demand. Palladium was the superior catalyst metal. Platinum had no future. That narrative crushed the price and kept it suppressed for years. But narratives change, and fundamentals eventually win. The hydrogen economy is flipping the script. Platinum is no longer the metal of the past. It's the metal of the future, and the market is just starting to wake up to that reality. When the gold to platinum ratio reverts to its historical average of 1.2, we're looking at platinum north of 5,700. And if the ratio overshoots to the upside, which it often does in bull markets, we could see platinum trading at parity with gold or even at a premium. That would put platinum well over $6,000 per ounce. Is that likely? I don't know. But it's mathematically plausible if the supply deficit persists and hydrogen demand accelerates. And right now, both of those things are happening. There's a historical parallel here that's worth studying. The palladium squeeze of 2019 to 2020. Palladium went from around $1,000 in early 2019 to over $3,000 by early 2020. Why? Supply deficit, industrial demand, backwardation. Sound familiar? The same dynamics that drove palladium to triple in less than 2 years are playing out in platinum right now. But here's the difference. Platinum is rarer than palladium, and the hydrogen economy is a bigger structural shift than the catalytic converter tightening that drove the palladium move. If platinum follows a similar trajectory, we're still in the early innings. The palladium squeeze didn't end until industrial users had secured long-term supply contracts and recycling ramped up significantly. That took years. And even then, prices didn't collapse. They just stabilized at a higher level. I expect platinum to follow a similar path. This isn't a pump and dump. It's a structural repricing that could take years to fully play out. Let me be clear about what I'm not doing, because it's just as important as what I am doing. I'm not selling my physical platinum into this move. I'm not chasing the price higher with new capital right now. And I'm not listening to the talking heads who are calling this a top. Why? Because I've been through enough commodity cycles to know that the crowd is always wrong at the extremes. When everyone was bullish on platinum in 2011, it topped out. When everyone was bearish on platinum in 2020, it bottomed. Right now, the mainstream is still skeptical. The analysts are still underestimating the move. The financial media is still focused on gold. That tells me we're not at the euphoria phase yet. When you start seeing platinum on the cover of major financial magazines, when retail investors are talking about it at dinner parties, when every YouTube finance channel is pumping it, that's when I'll start thinking about taking profits. But we're not there yet. Right now, this is still an insider's trade. It's still under the radar. It's still misunderstood. And that's exactly where you want to be in a structural bull market. Look, I'm not here to tell you what to do with your money. I'm here to share what I'm seeing in the data, what I'm doing personally, and why I think this move is different. Platinum just broke its all-time high in a vertical move that shocked the market. The fundamentals support a much higher price. The supply deficit is real. The industrial demand is growing. The vaults are empty. And the market structure, backwardation, is screaming that this is a physical squeeze, not a speculative bubble. If you've been waiting for confirmation that the metals bull market is expanding beyond gold, this is it. If you've been looking for the most undervalued asset in the precious metals complex, this is it. And if you've been wondering when platinum would finally get its moment, the answer is now. The question is, are you positioned, or are you going to wait for the mainstream to catch up, by which time the easy money will already be gone? I know where I stand. I'm holding my physical, I'm watching my triggers, and I'm prepared to add on weakness if the 2200 level holds. Because the math doesn't lie, the scarcity is real, and the structural repricing is just getting started. This is the moment platinum demands its throne. Don't let the noise distract you from the signal.